is 5:31 and there's only 3 of you, so I guess today is going to be a pretty small class. Unless people decide to join late. Yeah. So I'm going to share my screen. What do you mean due on Friday? Today is Friday. Yeah. If you forget to do it, we're going to do it in class anyways, because barely anybody does it. Like, if you do the homework, that's good for you, and it's extra practice. So last class, we started talking about the cost of production, and then in the long run, all resources are variable, and in the short run, the supply is not fully adjusted, so many things depend on that, and it's very important. And then we learned about the law of diminishing returns, which was each additional input and the marginal product will eventually decrease. And then we talked about some terms. Average product equals total product over variable input. Yeah, we talked about how this is not that important, and you won't find much about this on all textbooks. The ABC one is wrong. And we talked about marginal product and those equations. I hope you took down notes. And we talked about how there's 3 stages, and the 3 stages for marginal returns are increasing, diminishing, so decreasing, a decreasing rate of increasing, and negative, so it's just going down. See this curve right here, that's total product. And total product, yeah, that's the second one. The first one is marginal product, so you see it's this one right here. So it's first going up, then going down, it's going negative. So the negative part is pretty important. And then for average product, we see it goes up and it starts to fall. And it eventually goes decrease. And marginal product is the slope of the total product curve at each point. And this is not something you'll find, and it's not that important. But if you want to take notes on it, you can. Okay, so talked about how marginal product is at the average product's maximum. So when marginal product and average product touch, it is at the peak of average product. And when marginal cost touches average variable cost and average total cost, it will be at their minimums. So I'll draw a quick graph for you for marginal cost in case you forgot. Alright, my pen setting is weird. Alright, so I'm drawing this for a mouse. So we have our average variable cost and then our average total cost. So the average total cost will always be on top of average variable cost. Since one is the total cost, one is only one type of cost. I'm gonna change my settings on my tablet. What is up? Okay, my pen pressure is really messed up. I don't even know what happened. So I guess we're gonna continue. Alright, so never memorize this because memorizing this will never help you. And then I just drew the graph, so I'll draw it again. Alright, if the pen lets me because it's really messed up right now. Oh, okay, it's even more messed up. Technology is betraying me. Let me see if it still works. Yeah, it's still messed up. I don't even know why. No. Okay, so what I just drew, and then this is our price, this is our quantity, yo, and then we draw our marginal product, which is just an upside down Nike sign, and then we draw average product, and then at the maximum point, okay, it's not that good, but you understand, that's where these two curves touch. And the other one I drew before. Alright, so homework. Since basically nobody did their homework, I'll give you 5 minutes right now to just start doing the homework. So 5 minutes and I'll test you guys and see how much you understand. You did the homework, but you left, I remember very clearly you left the last question blank. So yeah, try again. Like maybe like just when you submitted the homework, you weren't that you were like half asleep or something. So try again. If you didn't take last week's class, like, please tell me and request to see the recording because I'm not going to reteach everything. Yeah, ask for a recording. Okay, I was just trying to fix my tablet, but it doesn't seem like it worked. So let's go over this problem right now. Okay. So we have our graph here. So let's first read the question. Assume that he spent $14, so that's his budget, and burger costs $4. So we'll write that down. Yo, I can't write anything now. What? Yo, that's weird. Right? No, that's $4, 4, and 2. Using the chart, answer following questions. What is the quantity of burgers and pizza that will maximize its utility? All right. So when you look, so it's you remember that it's mu over p. So we have, let's see which one, the marginal utility. So you divide everything by 4. So in the end, we get 5. Oh, I forgot, doesn't work. So we get 5, and then 4, 3, 2, 1. And then over here, we have 6, 5, 4, 3, 2. And Our first question is, what's the total utility of consuming 4 burgers? And then you just for your burgers, and then you just add up to 4. So 20 plus 16 plus 12 plus 8, and you get 56. That's the first answer. And the second one I was just doing, and you can see, let's see which one matches. So we have everything below this, right? And we just know that our budget is $14. And if we calculate, so let's say we buy 1 unit. So a burger, that means we buy 2 units of pizza. And that means we spend $4 on pizza and $4 on burgers. But we have so $4 on pizza, $4 on burgers, and we get 8. But we didn't use up our budget, so we go to the next one. So we buy 2 burgers, which is $8, and we buy 3 pizza, which is $2. And then we get 14, which is exactly our budget. So we buy two units of burgers and 3 units of pizza. And our next question, now suppose there's a 10% increase in burger that leads to a 5% increase in the quantity of slices per pizza purchased. So when you see this, it's obviously cross price elasticity, and we have to figure that out. And then so between burgers and pizzas, and so we put pizza on top, burgers on bottom, and we get 1/2. And since it is positive, the cross price elasticity, and that means there are substitutes. So substitutes. And if this was negative, then it would be complements. And you can't get whether or not it's inferior good just from the cross price elasticity. It is from the income elasticity. All right. Does anybody have any questions about this? So every time you get a free response homework, then we'll go over this in class. So next time, please do it. It doesn't really matter if you're wrong. It just tells me whether or not you guys are understanding the material. All right, so what is this blank slide supposed to be? Oh, I'm supposed to draw a graph. Oh, so this is just a graph consisting of ABC, AFC, ATC, and marginal cost. And this is perfect for like when we're going to talk about perfect competition, the next slide. This is going to be very helpful. Oh my god, what? My sensitivity just got quantity. So I usually draw the MC first, but it depends on who you are. It doesn't really matter. And we have the ATC minimum, and then we just go straight up. ABC minimum, we go straight up. And you wonder why we never talked about AFC, because it is fixed cost and it does not matter. So how you calculate average fixed cost is this distance between these two curves, but we're not going to be too accurate here. So I'm just going to draw somehow an AFC curve will usually look like. So it will usually look like this. a decreasing slope like that, that's AFC. Whenever you're drawing graphs, you only have to draw these three. You don't have to draw AFC because we're never going to get tested on it since it's only going to decrease no matter what. Does anybody have any questions on this? And we have our equations again, just to review. So fixed cost plus variable cost equals total cost. And then average fixed cost is total fixed cost over quantity. So when it comes to average in economics, we usually divide by quantity. Okay. And the marginal cost is just a Nike sign. And it's the change in total cost from the production of one more unit. So if they give you like a chart, you calculate marginal cost from the subtracting. Let's say you want to find the marginal cost of the second unit, then so we have 1, 2, and then maybe have like total cost would be like 1 and just be a 5. The marginal cost would be 5 minus 1. But if it's gonna say, oh, calculate, we have 5 here, maybe like 20, marginal cost of 5, so you do 20 minus 1 divided by change, so change in cost, 20 minus 1 over 5 minus 1, so you get the point. They were such good numbers, but so if the marginal curve is less than whatever average variable cost, average production, that means the average curve is moving downwards. Wait, I don't know what average. Oh wait, I don't know. So for marginal cost, it's with average variable cost. For more marginal product is for average product. So you can see here. So before they intersect, average product goes up, and after intersect it goes down. But that's the opposite. It goes down and it goes up for average variable cost. And we talk about average fixed cost, and we just said it's the distance between the two average total cost and average variable cost curves. So when the total product or the quantity is going up, then the average fixed cost is going down. Since the total fixed cost is never going to change, but the quantity is changing, so it's going to steadily decrease. All right, we're talking about taxes now. So I briefly mentioned before the taxes. So the per unit tax is for suppliers. And it usually talks about if you produce one more unit, it's a tax on how many units you produce. And it's considered a variable cost since it increases with the amount you produce, and it increases the marginal cost, average variable cost, and average total cost. But it does not affect fixed cost whatsoever, because fixed costs do not change, but this tax changes if you produce more units. So it's part of the variable cost. And the marginal cost will usually shift and it will decrease the maximum profit quantity. We'll talk more about that later. Since we're going to talk about perfect competition, this is going to be where everything kicks in. So don't be too scared. And lump sum tax. So this is part of the fixed cost because no matter how much you produce, it's going to be the same. So if I shut down, I don't produce anything, I'm still going to get taxed because the lump sum tax. Versus I'm this huge company making like millions of units per year. Yeah, I'm going to get taxed the same as the guy who shut down. So that's the lump sum tax. I'm pretty sure that's lump sum tax. But you get the idea. And it increases the average total cost since total cost is variable cost plus fixed cost, and it increases the average fixed cost. We're going to talk about the maximum profit quantity later during our when we talk about perfect competition, oligopolies, monopolistic competition. Next, we're going to talk about MR equals MC. But MR equals MC is super important point. It's going to be tested a lot. We went over this in the beginning of class. So the costs in the long run, they're all variable costs since in the long run, I can build more factories. In the short run, factory is a fixed cost because I can't just build a factory in like an hour. It takes months, even years. But in the long run, it doesn't matter. So it's all variable costs. I can build as many factories as I want. And there's no fixed cost because it can increase, it can decrease. It doesn't matter. Oh, okay. This is yeah, we're gonna talk about this in the next slide. So when we the diminishing margin returns, right? Because if you produce something and blah blah blah, it's gonna increase later, decrease later. And you know how the marginal cost curve looks. It first decreases and then it increases. So that's what we're trying to do here. So we have our graph. Sorry if this looks pretty sloppy because I'm drawing this with a mouse. This isn't too nice. So when we graph our average total costs for how many units we produce, it's just like marginal cost. You see marginal cost decreases at first. So at unit 1, we have this. So let's say this is 500 units. And then at this, we have another curve here. Oops. Another curve. It's going down, and then we're going up. And it's going to be looking like this. It isn't too well drawn, but in the end, it's going to first decrease, and then at a point 0, and it goes up. That's a basic idea. And then here is a more better drawn version. So what I just drew is the LRATC, which stands for the long run average total cost. And when it's the long run average total cost is decreasing, that portion called economies of scale. And then when it's flat, it's gonna be called constant returns to scale. And then we go up again, and that's the diseconomies of scale. So increasing returns to scale, which is just this economies of scale, that's just a different name. The output increase will be bigger than input increase. So you're basically saying, I invest, this is just an example. You put money into your business, like maybe $10, but then you earn way more money because you invested. But in diseconomy scale or decreasing returns to scale, you put in more money than you earn back. So that's kind of the idea. So this doesn't sound really good. This sounds super good. And marginal returns is the difference, marginal, which is difference between the second unit, first unit. So, and diminishing marginal returns. That's what we're talking about all the time. Eventually, what you get in return will decrease. Is there any questions about this? All right, doesn't seem like there is any. And we're going to talk about productive efficiency, which is MC equals AC. We're not going to talk much about this because in later units we're going to talk more, since it's going to be more applicable to the things we're doing later. We're not going to talk about the different types of profit. So revenue accounting profit is, from the name you can see, like, it is accounting, it's just raw numbers. So it's revenue minus explicit cost. And economic profit, from the name you can see, like, you're counting all the factors in to opportunity cost and all those stuff. So you can see it is different from accounting profit. So it's accounting profit minus the opportunity cost. Okay. So if you just unplug, so you expand the accounting profit, so it's revenue minus explicit cost minus implicit costs. Implicit costs are opportunity costs. It's just a different name. And then for normal profit, we have economic profit at 0. And it's efficient. Alright, so this slide deck is done. We're going to do some exercises. So, which of the following is true? Alright, I need answers in the chat, please, or I'm going to cold call on some of you guys. No uhs. All right. Recall, look into your notes. All right. Notes are especially important in economics. And we're going to be drawing a lot of graphs in the next slide deck. So it's really important to take notes because screenshotting won't help you. Drawing the graphs themselves will help you get experience on how to draw those graphs and how to most efficiently draw those graphs. And since you're writing, your muscle memory takes over. So when you slam with the problem, like you can, oh, I understand. I remember this from class. But if you're taking screenshots, it's not going to work. So we have a decent amount of answers. And it is A, so total cost equals, well, total cost equals total variable cost plus total fixed cost. Let's look at B. Total fixed cost equals margin cost plus average total cost. Okay, that just doesn't add up. So get away. And average variable cost plus average fixed cost equals total cost. No, that doesn't match because it's average. It can't become total all of a sudden. Margin cost equals total cost minus total fixed cost. No, I don't think marginal cost is the change in total costs over the change in quantity, so that's wrong. Average total cost equals average variable cost plus marginal cost. No, that does not work. All right. Okay, this is a bit harder. So accounting profit. You all remember it? Do you all remember accounting profit? If you do, this might be much easier for you. Okay, now it's asking economic profits. So economic profits were accounting profit minus opportunity cost. And accounting profit is economic profits plus opportunity cost, if that helps. All right, so I see many answers and none of which is correct. So a lot of people said A and B, and there's one E. So the correct answer is C. So let's see the problem, $100,000, and he could have. So that's the opportunity cost. Do you remember I just told you accounting profit, economic profit is, okay, this does not align up to what I said before. I need to check. So economic profit equals the total revenue minus explicit and implicit costs, and accounting profit, which equals revenue minus explicit costs. So accounting profit, implicit costs is opportunity cost. So economic profit, you subtract, since accounting profit already does not include explicit costs, now we just need to minus implicit costs. So we subtract $60,000 from $100,000 and you get $40,000. I think I messed up somewhere, which ended up confusing you guys. So next, last question, and then we're gonna move on into perfect competition. This should be pretty easy since, so remember what increasing returns to scale, decreasing returns to scale, constant returns to scale. So okay, I only have 2 answers in the chat. This, on the first look, seems pretty easy. But if you think about it, it's harder, but it's not that hard, all right? So, don't mind the voices. So, from here we can see with capital fixed at 1 unit, all right? So fixed is a big word here, fixed. And with 1, 2, 3 units of labor, and then we can see it is decreasing. So 300 to 350 to 370. All right. So that we can see it first goes from 300 to 50 to 25. So that's decreasing marginal returns. So we can cross out any of the increasing ones or constant ones. All right. So now we only have these 2 answers. And I just circled the fixed. And remember, in the long run, there's nothing fixed. There's only variable cost. So B is out of the question. So the answer is D. All right. Is there any questions? No? Okay. I'll stop share. And we'll move on to perfect competition. All right. One day we're going to have a Kahoot day. Since we're actually moving at a very, very fast pace. I think we're almost catching up to where we are in econ class. So that's a bit worrying. All right, let's see if my pen decides to work right now. So I'll first do this, and then do this. this work? Let's see. No, it still doesn't work. Oh my god, what is happening? Do I have to, like... Oh yeah, I forgot to share. Percent. All right, perfect competition. So anybody want to recall what the 4 types of market structures are? So Jeffrey, do you remember the 4 types of market structures? All right, Jeffrey does not know. How about, hey Kevin, try and guess what the 4 market structures are. Hint, hint, I said it in class a few minutes ago. Hint.
Perfect competition, monopoly,
Oh, yeah, that breathing, yeah. All right. So you only said 2. So Evelyn, do you want to guess the last 2? Evelyn, you turn on your mic. Mic. Don't chat. This is where you show your confidence here.
Oligopoly and monopolistic competition.
Yes. All right. That's exactly it. So yeah, perfect competition, monopolistic competition, oligopoly, and then monopoly. So, okay, I'm just gonna say it. So perfect competition is something that's pretty rare in the real world, but it's the dream economic, well, not dream, but like the most basic economic market structure. So in a perfect competition, there are low barriers to entry and exit, and every single producer produces the same thing. All right. And there's no ads, and they produce at the same price. So an example in the real world will be agricultural market, since if you're growing, let's say, tomatoes, you're not going to price higher than another person who's doing the exact same thing as you, because you're just tomatoes. There's nothing different. All right. And then there's monopolistic competition. So it's kind of like a perfect competition market, but it has some differences, such as they produce different things, they produce different products, and they have different prices because they have different products. And an example of that are restaurants. All right. Restaurants, they produce different foods, they have different cuisines and stuff. So you're willing to pay more at a 3-star Michelin restaurant as opposed to just like a street vendor. Like you're willing to pay like hundreds of dollars at a 3-star Michelin restaurant. Yeah, and I'd rather pay like only $5 at a street vendor. And if they charge more than that, I'm not eating there. All right. Next is oligopoly. And some examples that come to mind in the oligopoly are smartphone markets, that's oligopoly, and a lot of markets are actually oligopolies. Oligopolies might be the most common market in the world. And oligopolies have high barriers to entry, but it's easy to exit because you can just exit. So high barriers of entry, and everything else is just like monopolistic competition. Okay, and what I just said, smartphones, and this is the most recent iPhone 12. All right. So in the phone market, you're only gonna buy from Apple and Samsung, and not really any other companies. But these are the two major companies you want to buy from. And then we have monopolies. They are rare. Monopolies are very rare in the real world, because the government's gonna crack down on them and say, no, we're breaking you up. All right. In like the 19th century, the industry was booming, and then there's just this guy like Rockefeller and stuff just create this huge monopoly, and the government just broke the company up into like 50 other smaller companies. So that's what monopolies get. But the government are still not going to break up some monopolies, like PG&E. That is a monopoly. Google is like on the borderline of oligopoly and monopoly. It's like legit on the borderline, because they have majority of the market share, but if you don't have Google, like you can still survive. Like if Google suddenly just went down, I have like Bing, DuckDuckGo, and all that good stuff, right? So it's not technically not a monopoly. Like DuckDuckGo isn't that bad, or Ecosia or something. But if PG&E suddenly just left, like we won't have gas or electricity until somebody makes a company that provides it for us. So PG&E is a monopoly, but they're not going to break it down. So PG&E is something called natural monopolies. And a question that is asked a lot is that, why do governments allow these monopolies to function? Well, here's the deal. Um, PG&E can't raise their price absurdly high, because first off, the people are going to get super angry, and the government will be like, no, you can't do this. So that's why they still allow PG&E to function. All right. And here is the golden rule of perfect competition markets. MR equals MC. That's what I was talking about in the beginning. So MR equals MC, and you'll see this applied later when we draw some graphs. And okay, so I just said that low barriers to entry and exit. Since if in the perfectly competitive market, you start getting an economic profit, more producer will join the market, leading you to get a less profit, and eventually in the long run, you'll be earning zero economic profit. All right, that's really important. Zero economic profits in the long run. All right, and you'll apply this in graphs later on. And here's some terms. I hope you guys already have this down, because we talked about this a lot. So I just told you some characteristics. So take all these notes down. For this, you can screenshot, because writing it down doesn't really help you. And for perfect competitive markets, they will always be allocative efficient. So price equals marginal revenue in the long run, and also productively efficient. So price equals minimum ATC in the long run. And later on, when we see where the ATC is placed, it defines how if the firm is earning a profit or incurring a loss. If the ATC is above the price, then it's a profit. If it's if it's above the price, then it's a loss. If it's below the price, it's a profit. I messed that up. And another point is Mr. Darp. All right, so it's MR equals D equals AR equals P. That's much easier to remember, but here's another version. And perfectly competitive markets are price takers. So they don't decide the price, they just take the price. And the other parts I said before. And they are perfectly elastic demand curve, since if you raise the price, nobody's going to buy from you. Since it's another producer at the lower price. All right, here is where I draw a graph. Price and quantity. And, oh shoot, I forgot. You have to draw two graphs. That's very important, two graphs. All right, this is the market. And that's where you have the supply and the, oh, what is that? All right, so demand and supply, and we have equilibrium price, equilibrium profit, quantity. What am I saying? And then we draw a second graph here. This is the firm, all right? If I have a pen, I would draw this better, but you have to deal with this class. I don't know what happened to my pen today. So you'll draw this line across the firm. Oh, and this we have our Mr. DARP. MR equals demand equals average revenue equals price. And then we'll draw our marginal cost. And we will draw our average total cost. And then we will draw our average variable cost. And that's all you need to draw, I think. Let me check. Yeah, that's all you need to draw. Very simple. And this will be the quantity produced, and this will be the price. Very simple. So does anybody have any questions on how to draw the perfectly competitive market graph? Okay, it's 6:30. You guys are free to go. You can stay behind if you have any questions.